Samir, for those who are in the market right now, it's a great market. It's like a carnival. Every day stock prices are going higher. But for those who, in a sense, had a bearish view, they were concerned about the economy, they were concerned about concerned about the earnings. And for those who have not participated, this is a very miserable time because each day stock prices are going higher, and you have not participated.
Actually, that is not true because that depends on what is your starting point. So, if you had been miserable about the economy for the last 1 year, it may have turned out all right. Actually, what if you turned miserable at the end of 17 after that big rally? So the point is, it all depends because that's the whole business of investing. That it's a continuous game. And if you benchmark yourself and say, oh, on 23rd March, I should have bought, well, then sorry, that is not going to happen. Because even if you had bought that day, if you had 100 rupees and you were generally miserable and you turned only that day, you would have put 5, 10, 3% of your money in one trade and felt happy. So the idea, what I'm saying is, don't look at it like that. Don't benchmark of the best possible day to buy or the day on which you had no guts and then regret for the rest of the rally. The point is to say in general that what are your investment choices and how much risk you can take, and mostly the markets being forward looking and positive generally work out in the long term and even in the medium term, and these days even in the short term.
How does one assess a stock like Reliance? It now accounts for more than 15% weightage on the Nifty. It has morphed from being a petrochemical company now to a tech company. We understand that they're also looking at raising stake or selling a stake in the retail business. What is the best way now to understand Reliance? I mean, should we compare it with the kind of P multiples and the kind of excitement what global FANG stocks are reporting? Is Reliance the new FANG of India?
Actually, if you were to compare it to FANG stocks are cheaper. So don't look at it like that. Look at it that within India, it is the biggest transformation. And that one part, and now the second part, the retail part, will get a lot of interest. And more than that, now it is on everybody's global. I mean, for all global investors, also, it's a fair stock to look at. It's a 150 plus billion market cap. And if those people there have been investing in Facebook and Google and all, they would themselves be surprised that both these guys are together in one company and along with 10 other private equity guys or whatever. So now it is in a different bracket altogether. It's now a real global stock, but you can't look at it P like this because here the P still is coming from the old economy business, which is oil and gas. It's a SOTP business, sum of parts business. Yeah, we are very interested in the stock since the day Facebook bought, as I said last time.
Right. Yes, I think you've come on record on the channel and you have applauded the kind of work what Reliance has done in terms of transforming themselves. But I'm just going to have one more follow-up question on Reliance, Samir, because this is something which in a sense has come forward now. That in India, funds right now cannot own more than 10% in a single stock. Reliance's weightage on the Nifty is about 14.5 to 15%. So do you think there is going to be a bit of a challenge right now for mutual funds because purely because of compulsive factors, you can't participate?
No, that is true, actually, but most of Indian fund managers won't have Nifty as their benchmark. They may have, the 200 or the BSE 500, I assume. For us, it is MSCI India. And actually, we don't look at it, but I'm sure it's more than 10% there. But it's our benchmark. But since we mostly outperform it, we don't look at from where it comes, except to see the big weights in terms of sectors and all. But I'm sure it's more than 10%. And we obviously don't have 10 and we don't even have 9, but we have a large position. So from the way we manage. But the point is that now whether that should be allowed or not allowed, I think I don't think that the SEBI or somebody should say that it can be as high as index. That's the definition of a fund, that it will not take such extreme positions. And by the way, let us say you did not take this extra 5% or whatever in Reliance and you instead bought with that 4 other stocks which have done as well as Reliance. You could have compensated for it in general. And sometimes, it goes the other way around. And for many years, these fund managers who come and say that we buy only stocks which sell small, small things to small, small investors every day because these things will never end. Basically, they were outperforming because, let's say, Reliance was not doing well. So it works both ways.
Sure. Samir, as you mentioned, it's about where you get in. How much more room do you see in this rally? Is it just the beginning? We've also got markets globally now upbeat just on news surrounding a vaccine, even if it's still a 60-70% success scenario that we're looking at, but definitely something that's impacting sentiment positively.
So I think the main thing is that the pace of this rally is a bit unnerving, but not the extent, maybe you can say. For example, if this market this month is up 8-9% or even 10, I think, if it had just happened a bit more gracefully over 3 months, everybody would have been happy with it. But the pace of the rally is unnerving because everybody thinks that what has happened suddenly. Actually, nothing has happened suddenly, and that is why it makes people nervous. But if you look at it over a year, we can say that, last year the market was okay. It was up like whatever, 8-9%. And the year before, other than 3-4 stocks, it was down maybe 15%. And if we look at purely the extent of the COVID, then for the moment we are assuming that it is a 1-year issue. That means that it has wasted 1 year of economic life of companies, of GDP, of investors, and a removal of 1 year of an economic, sort of, let's say that you are looking at the beginning of this year at what may happen to the corporate earnings or GDP this year, and now we say that, sorry, this year is not to be counted, we will straight away move to next year. What is that worth? We think that is worth 12-15% type of a fall, because that is how much you would have made in the market if everything had done well or normal. Now the question is that some stocks are down 50%, and you may look at them and say that that is fair or not fair. And then there are stocks that are up 10 and 20%, and you may look at them and say whether they are fair or not fair. So we found there are 3 consumer stocks we actually sold after holding them, one for 5-6 years, one for maybe 3-4 years, and one for 1 year, because they were up 15-20% when they are as badly hit in India as anybody else, including the biggest retailer in India. If he's going to have 40% down quarter, on what basis was the stock up 25 and 30% a few days ago? So, that would be a return from a perfect good year where everything went well. We no longer can accept in this market that I have done the best I can. It's just the COVID which has hurt me. For stocks that have very high valuation, the fact that you got hit from an angle, it doesn't matter. You have to fall for it. So theater chain can't say that I do such good job, my food is so good. What can I do that the coronavirus has hit us? So my stock should be up because on my own I execute very well. It doesn't work like that. So you have to fall at least somewhat to reflect various issues, and some of them are not. So I think the job of an investor right now is to say that whether the stocks that are down 50%, is that fair or not fair? And the stocks which are up, fair or not fair? And for the rest, you go along and buy because they reflect a normal 1 year wastage of our life, which in the case of financials and many other companies, they are all down 15, 20, 25%. To me, that looks perfectly fair for wasting 1.5 years.
Okay, interesting. Samir, in the context as well that you've highlighted, then what about the health of the financials? While they're proceeding with caution, looks like moratorium is falling. We have seen that stock price action, particularly on select names. How would you assess the potential when it comes to some of the key financials?
So broadly for the banks, we think that the fall is not less. Because even after this recovery, they are still down. I think HDFC Bank might be down a little less, but ICICI and Axis on the other guys are down in 20s or higher. And that looks fair from a 1 year, if it is a 1 year issue and it is not really let them go out of hand. So in a broad sense, we like financials, but some preferences have changed within the universe. For example, we used to own microfinance, we don't have. We used to own the wealth management, we don't have. And instead, we have more of the private sector banks and this gold finance company and all that, and the card company.
Samir, what about pharma? The street seems to be chasing pharma, and even X of a COVID vaccine, these companies are delivering excellent numbers, be it a Divi's, be it an Alembic Pharma, even mid-cap pharma is, joining the party right now. Agreed that these stocks are already sitting at their long-term averages, but do you think because the story has just been discovered for the last many years, the stock, or rather the entire sector was under-owned, undervalued, there is still a meaty investment here?
So, my thing is that we did not own any pharma before the problem started. And I think I said it also last time, because I don't like the sector. I don't understand the sector. We just bought 3 stocks and said, stop irritating us. And so since then, we are not irritated because we have them. But if you ask me, then you'll have to ask my analysts more than me. But we have just, sort of covered our base there rather than trying to predict. Because generally, I find the sector very difficult to analyze. And if you even have a successful product, for example, I remember on this some medicine which they said was going to be used in COVID, the stock went up 35%. I mean, these are things I don't relate to and I don't have it in my bones like I have for some other sectors. But we have 3 3 pharma stocks now aggregating to maybe 7% and sort of we have blocked it off our head. It's okay. They are going up and down in line with whatever happens. But generally, I don't like them beyond that to do research on those stocks. Personally, I'm saying.
Sure. What about specialty chemicals?
Done whatever he has, and I accept it.
Rosari Biotech, for instance, as well. Okay, fair point. So, what about specialty chemicals? Because that's been a discovered story even before COVID. And I was just looking at Rosari Biotech, the new listing from yesterday, and what a fabulous one.
No, true. But what happens in these IPOs is that either the stock is so hot that you don't get anything, or it basically falls on you and devolves on you. So in the end, even if you look at the guys who get anchor, once in a while we also throw in our hat and get a few $500,000, $1 million, $2 million, sometimes $3-4 million. But there are all these big guys who come in like, the big mutual funds and the big global sovereign guys who get on paper $10-20 million of these stocks. But considering their own sizes, they also don't move the needle. So in the end, the IPO part itself, nobody makes money. So now you have to analyze it, whether it is worth it or not, because if you get a little and it goes up 50%, of course, it's great to have that extra money, but then it is still not changing the NAV by, in a decimal sense. So that's why beyond a point, we have to look at it from now on and then we'll see how it goes. But we have the older ones. Yeah. We have the other ones, not this IPO which happened yesterday.
All the analysis, Samir, all the analysis just comes down to one point. Market price is a function of EPS and PE. Where do you see scope of earning expansion and where do you see scope of earning and PE expansion?
No, it is not true that it is like this, because how does PE get calculated itself is a major part of the story. So the point is that your alternatives decide also what will be done to the market. So as I said, my way of looking at it is as follows. First, that in the big picture, accept that equities beat debt over the long term. Now, somebody will smartly get up and say, over the last 10 years, from 2007 end to now, if I had bought, I would not have got. And I'll say, no, why don't you look at it from 2008 end and stuff like that? So there is a never-ending thing. But the point is that over time, equities beat debt, and you have to have a positive frame of mind in this. Secondly, we are always assuming that what was happening a year ago or 2 years ago was a fair valuation, and from that point we are calculating. So sometimes somebody may say, but why are you saying that the stock prices are down from 2017 and 30%, 40%? Because actually 2017 rally was wrong. So, okay, we'll say, okay, no problem. Let's look at it from 2016 end. But you'll always be benchmarking of some previous number. So today I am benchmarking of 2020 pre-COVID, saying that for whatever reason we had a positive bent of mind because for 2-3 years the mid caps had not been doing well. The market was we were hoping will broaden, and then this COVID came. Now this COVID, we are taking it as a 1 year kind of a problem where for whatever reason we don't know whether it is therapeutic or it is vaccine that somehow things will go back. It's possible that it takes another 6 months, but it's not end of the world kind of thing now. So in that case, we are only benchmarking and saying that, for example, if a stock is down 60% also, we by the way bought 3 of them recently, 2% each, that are these gone because of the COVID? We think they are not gone. And therefore, even if 2-3 years later, things become normal and these stocks go back only to the prices that were there in Feb, or even if they don't go back, they go back some of it, you will make 50, 60, 80, whatever percent cumulative return. So, and then there are stocks that have fallen 20-30%, which happens to be mostly these private sector banks and some of the financials. And we feel that is a fair cost of a 1 year bad performance in an absolute sense, but not in a relative sense. And so you are juggling within this, but always being there. Also, please note that, you said, Nikunj, in the beginning that these 5 stocks in US or Reliance in India is doing well. Actually, in the US, more than 150 stocks this year would have beaten the S&P by more than 5-10% per annum. In India, you could have bought at least 3 that we own, but there would be many stocks which are up 70-80% this year. In the calendar year, we are not even talking from COVID bottom. We are talking year to date. So the point is that a number of stocks do well in a market. And it is that the biggest stock doing well changes the index itself. But if instead of index or that biggest stock, you had bought 5 smaller stocks, of course, we now have Reliance as our biggest holding. But I'm saying in general, there are many ways of doing okay in market and waiting for an overall recovery instead of saying this thing. The point is, whatever you do, some 100 stocks are going to beat the market by at least 10% per annum. You can see I have this data for the last 15 years. We can go back and do it for 30 years if somebody says. It happens every time. And it is happening in US even now. There was a recent report by Citibank on the same thing, but I've been saying it for a much longer time, and maybe they also were thinking, the Citi US guys, that the breadth of the market looks narrow, but it is still adequate every time. And that is why I think that Warren Buffett is making a big mistake in waiting to invest $100 billion in one investment. If he had just invested in 10 stocks, $10 billion each, he would have done much, much better because there are rivers for him.
Samir, also wanted to chat with you about this entire steel story. Where is that headed? Because you always invest in steel when the cycle is at a downtake. I was just looking at one of the brokerage notes on steel, wherein they do believe that there will be further price hikes in the month of August as well. The stocks as well have lifted off quite a fair bit, but do you sense that there is a investment here in the metals universe?
I deliberately let you ask a very long question because I don't look at steel and we would delete the email before it hit the box. So we don't do this. Sure. We only invest in 3 themes, or maybe sometimes we expand it a little bit here and there, but that is financials, consumer, and IT, pharma, and now we put specialty chemicals in that as an exporter, and once in a while, some too big to miss kind of a stock. But otherwise, we don't invest in cement or steel or tea or copper or fertilizer or general chemical or leather or whatever else you have in the country.
Sure. Staying away from commodities at large. I hope that doesn't apply to gold and silver though, Samir, because they are the ones where the maximum amount of revenues are getting generated.
No, gold, I'm very bullish. Personally, also now I own more than 10% in gold. I own the gold currency, which is called XAU. But gold is hot. But gold is still a trade. But gold is an easier one right now, I think, because the amount of money printed is too much, and the interest rates in dollar. I was trying to put a deposit before I said, "Screw it, I'm going to buy gold." It was I think 2% per annum if I put it for 6 months, and this was about a month and a half ago. So yeah, I mean the thing is for people who don't know what to do with dollars and everything else. This gold is an easy play, but anyway, there are too many dollars in the world, and yeah, right now gold is good and it's good. But in a fund, we will not have all these things because fund only buys stocks. Uh, but we have both the gold company and the gold finance company, but those we had before.